All right.
Hello.
Hi, guys. Hey, Justin. Hey, Erwin. And Soraya is about to be on.
Hey, what's going on, Cliff? Thanks for having me.
Yeah. Thanks for.
Hey, how are you guys? Thanks for having me.
Erwin, how'd you hear about the webinar?
Conrado told me about it. He sent me the link.
Oh, Conrado. Yeah, he's one of my clients. How do you know Conrado?
He's an investor. I'm actually a realtor out in the Sacramento area, and I'm looking at getting into investing and just
cool.
learning more about it. And he told me that this was a good to learn something new to learn.
Heck yeah. Good for you, man. Joining on
Thank you.
Wednesday lunchtime. We knew that this was an odd, not the best time to set up something like this, but it just kind of worked for the different time zones that we're in.
Of course. Thank you.
Thanks for joining. Yeah. Justin, what have you been up to? I'll see you later tonight at B-Ball.
Yeah, no, I'll see you on in a bit. Been good. I picked up a couple new listings this past week, so just trying to keep pushing, you know.
Cool. Yeah. Justin and we play basketball a couple times a week together, and he's a commercial broker out in the East Bay.
Oh, nice. What kind of commercial?
Multifamily is my bread and butter, but
Oh, wow.
do a little bit of retail and
Okay.
a little bit of land too, but mostly multifamily.
So multifamily in East Bay?
Yeah.
Oh, cool.
And just as we'll get started in a few minutes. I like to just start 5 minutes after to give people time to get settled in and all of that. So cool. Hey, James, good to meet you. How'd you hear about the session?
Hey, Cliff. I've gone to a couple of the meetups in person, and I got this email for the Zoom, so I decided to join in. So thanks for having this.
Heck yeah. Thanks for being here. Are you in the Bay Area?
Yes, I'm in San Francisco.
Oh, cool. I'm across the Bay. I'm in Oakland, but we were in San Francisco for 10 plus years before that.
Nice.
So cool. Are you an investor, real estate agent, broker?
Yes, investor, mainly multifamily and commercial, industrial.
Cool. That's great.
Awesome. So you're in the SF Bay Real Estate Club meetup?
Yes, exactly.
Oh, awesome. Which events did you go to?
Oh, let's see. There was one with I forget her name, but she's someone who's done a lot of flipping here in the Bay Area.
Elisa Covington?
I think so. That might have been. Yeah, it was a while back, and
Okay, cool.
yeah, it was downtown, down by
Okay.
S. And then also went to one of the more informal meetups down at on Valencia.
Cool.
Okay, awesome.
Awesome. Yeah. Lisa, I feel like has been a very prominent name, especially like in SARE and some of the other Asian real estate investor groups. So cool. All right, we'll give everyone, I don't know, another 10 seconds. Oh, it's 12:05. Okay, we can get started now, and I'll just let people in as they join. But yeah, just wanted to kick things off and wanted to say thanks so much for attending and coming during your lunch session. Now we know who the hungry real estate investors are who are willing to sacrifice during their lunchtime to learn more about real estate to join. Today, we're honored to have Brenda Chen join from Conventus. She's head of sales at Conventus. Funny enough, I used her back in 2019 on one of my first flip projects out in Philly. And just as a little bit of background, I'm sure she'll get into it, but hard money loans, it's a good option for investors because it doesn't have the same income qualifications. And, you know, for example, if you don't have W-2 at the time, that could be an avenue for you to pursue with a hard money private lender. And she's just a complete wealth of knowledge. She's so helpful. She knows the space really, really well. She's built out the sales team at Conventus. And it's just an honor to have her here so that she can share more info about Conventus and the private lending world. So thanks, Brenda. I'll let you kind of kick it off and get started. And then just as a reminder, so we have until 1 o'clock or the next 50-ish minutes. Feel free to jump in with questions. We'll try to make this super just casual. I'll probably have questions here and there, and then we'll have a little bit of time for like Q&A at the end too, if the slides don't cover some content. So yeah, go ahead, Brenda. Yeah, and welcome.
Awesome. Thank you so much, Cliff, for having me. And it's really great to be here after, knowing you for a couple years now and seeing all the great work that you're doing. So thanks so much. It's such an honor to be here. And thank you all for attending this event. Like Cliff said, it shows that you're putting a lot of effort into this, and hopefully we'll make this worth your while. So the topic today is hard money loans and how they work. So we'll get into it. So my name is Brenda, and a little bit about me. So I'm a real estate lender and investor. I live in San Francisco. So I work at Conventus Lending. I've been with them for almost 6 years now. And since I've been there, I've funded over 1 billion worth of loans and thousands of transactions nationwide. We're in around 40 states. And the company has done over 3 billion since they started in 2015. I'm the founder of the SFA Real Estate Club. I believe some of you are from that group. So you can join at meetup.com/SFBRRRR, and we have 1,300 members and events there, happy hours, speaker events, and things like that. And I'm the founder of Venus Ventures, where I invest in real estate, and I completed 4 flips in San Jose with two of my partners, and I'm looking to invest going forward. So I'm still looking for projects, and you can find out more about me on my website there. But yeah, I just love getting to know people. So feel free to message me after. I'd love to help however I can. I love connecting people through the SFA Real Estate Club, and I know investors all over the US. So if you're interested in specific markets, I'd love to help out. So what is hard money? So hard money is basically a private loan with more flexible terms for business purposes. So the term comes from it being based on hard assets. So instead of lending based on income, we lend based on the hard asset. And so what the difference is between traditional financing and hard money financing, differences are typically traditional financing, you need at least 20% down, even more for commercial properties. I know some of you are in the commercial space here. You need significant DTI requirements, and they look at your income like holistically. They don't really look at the asset itself. The closing timeline might take 30 days or even longer. And hard money financing is as little as 10% down. That's typically for pretty standard single family houses for 10%, and experienced clients. So around 10 to 20% down, which is less. It's based on the asset's value, not your personal income. And you close as soon as 5 business days. That's on the faster side, but it just shows what can be done and what's possible. So yeah, feel free to jump in if you have any questions.
Brenda, can you talk a little bit about kind of the differences there? You said 10 to 20% down based on someone's experience. So my understanding is like if you've done there's some sort of threshold. If you've done 3 flips in the last 12 months, then you're considered more experienced. So it sounds like based on that type of criteria, not the person's personal income, you guys may adjust terms slightly.
Yeah, exactly. So different lenders have different criteria for what they qualify as experience, but most of them will look at number of projects that you're on title for, usually within the last 3 years. And some lenders care more about whether you added value to that property. So if you're looking to do a flip, they might want to see that you've done flips in the past. So not just like buy and hold projects. So different lenders have different criteria. We kind of look at both. So we do count experience, even if there's been no value added and you just bought a rental or something to hold. But for projects like ground up construction and projects with larger rehab, we might want to see that you've done work that's involving value add to count that as experience. But if you do know what you're doing and you know, we'll have an interview with the construction team and all that, then we can still qualify people, especially if they have enough liquidity. So it's more of like a holistic picture.
May I ask a question?
Yeah.
Hi everyone, I'm Alex. I'm a luxury realtor with Conventus. I have done a couple residential flips. I've actually used Conventus a few times.
Oh, awesome.
My question is on when you are your money, the amount down and the projects that you have on your project list. Normally it's how you use criteria of people who are on title to determine what your percent down is. However, I have partners who want to back me that have lots and lots of experience, but they are not on title. And I want to know, or they don't want to be on title for my flips. So I wonder if those flips can be considered usable or not.
Yeah, typically lenders won't consider that, but it's about the story that you tell to your lender too. Later on, we'll get into how to get the best terms. So it goes into developing a relationship and telling them a story like, these are the partners that I have, you know, here's their portfolio, here's their website, this is, you know, the track record that we have. And then maybe having them get on a call with the team, whether it's credit or construction, just to talk about the project so that they can get more comfortable around what you're doing. So I do think, yeah, communicating that would help. But as far as like a hard rule, like they typically don't. It's just kind of like a hard line they draw, that they have to see people on title to count as experience, because they have to make the rules. Like they have to, yeah.
That makes sense. Thank you. I appreciate that.
Yeah, no problem. And thanks for using Conventus. Okay. So why hard money? Faster timeline, close in 5-10 business days, and we can, for commercial projects, you know, it could take longer, probably like 2 weeks, 2 to 3 weeks, which is still faster than traditional banks, and easier application process, no income verification or tax returns. It's personalized for the client. So we look at what kind of project they want to do, and we personalize the financing for them. So what I mean by that is we'll look at, you know, whether they care more about getting a larger construction loan, or they care more about the term of the loan, like if they need to hold the project for a long time, we take that into account. Some people care more about pricing, so the upfront fees that you pay. So we kind of understand what people are looking for, because each project is so different and nuanced. And then we provide different options for them. So we might provide options that optimize for 2 of those things or all of those things, or so they're just different levers that we can play with to make sure that the financing is optimal for the client. And so we kind of look at it as being a partner for the clients instead of being a traditional bank where you have to jump through all these hoops just to get a loan. And it might take a long time to get someone to respond to you. We kind of look at financing as really a service that we're providing to investors, and we look at it from the investor's lens, because a lot of investors, they're putting their hard-earned money into these projects. They care so much. It's a lot of work, and we know what that's like. And so we want to make the financing part easier for people. And so it's also based on the asset, like I said. So the property has to qualify on its own. So for things like single family, 1 to 4 units, that's more of the value of the property. So we look at comparables that way. For commercial properties, 5 units and up, or mixed use properties, or just strict commercial properties, is more based on the income. And so we don't look at the income holistically with other properties and personal income and all that. It's just based on the property itself. So if you get a great deal, it's easier to qualify for, versus sometimes even if people get a great deal, they might not qualify because, you know, for example, like they don't show enough income on their tax return or something. And we also offer construction funds. So we can add that onto any type of loan, whether it's like a purchase loan or a refinance. We can add that on top of different asset types too. So we do everything from land to single family to multifamily to ground up construction to, adding ADUs and different creative ways that people are adding value to their properties. And so we can also lend on traditionally unfinanceable assets. So things like fixers. So investors are always looking for opportunities, and that's their edge. So we help them with that edge by lending on assets that traditional banks don't lend on, so that they can add value in creative ways to either flip them or rent them out or stabilize them. And so a lot of times to add the most value, you need to find assets that may not be financeable, whether there's fire damage or there's like a permit issue or code violation or something. But as long as we know that there's a plan to get those cured, then we can finance them. So we're a lot more flexible. And so who is hard money for? So the most important thing is that it's for business purpose only. So we don't do consumer loans. We don't do owner occupied loans. So they're for flippers, rental property owners. Sometimes people just need to buy a project and they don't want the construction loan yet, because when you're getting construction loan, you might have to pay fees on the construction portion and you're not ready yet, or you need to see if they get approved permits or something. We can also do mixed use, commercial, land, unique projects, cashing out for business purpose. So it doesn't really have to be for real estate, it just has to be for a business purpose. So ideally the property itself is an investment property, and partnership buyouts, transactional, which is pretty vague, but sometimes people just need a short duration loan to bridge them to the next financing. So for example, we had this property that we lent on in Atlanta, where it was a couple hundred units. They had like a pretty traditional loan, but they were given a lot of requirements by that lender, and they were about to sell it. So they didn't want to fulfill those requirements and be in default. So they wanted to basically refinance that lender out so they don't have to fulfill those requirements because they already had the property under contract. So very unique scenarios like that. And then also renovations, ADU is pretty popular these days. Any type of renovation or construction, so adding square footage, cosmetic, rehab, and then ground up, like I mentioned before.
Brenda, are there any requirements on how the property is held under title? Does it have to be an LLC or can it be personal name?
So we can do both, but some states right now we do require. So we have a list of those states. So I know Texas is kind of by exception. So there are some states like Ohio or but California, we can do both. Okay, so who is hard money not for? Like I said, owner occupancy, people with no skin in the game. We don't really get these requests these days, so but we don't do 100% financing like most lenders. Some people do raise money for the equity part, but we do like to see that they have experience doing this, because we, as a lender, we want to see skin in the game, especially if it's a newer borrower, and just so they know what they're doing. And once people have shown us they have a track record, we're more comfortable with them raising for the down payment. So obtaining a hard money loan. So it's pretty straightforward. You apply, send an application, you let them know what the details are for your project, like square footage, what the as-is bed and bath counts are, what it is right now, past experience on title with investment properties, liquidity, construction costs, scope of work, and then you also want to tell your lender what it's going to become. So it's pretty, as far as the project, they want to know what it is right now, what you're doing to it, what the value add is, if there's any, and then what it will become. And so that's how they will order the appraisal to confirm the as-is value, and then whether your business plan makes sense in terms of the after repaired value or as completed value. And so right now we're requiring appraisals for loan amounts of 400K, but every lender is different. And so we try to make it flexible because appraisals sometimes are the bottleneck for transactions. So we might be able to be flexible and do a broker price opinion, which takes like 2 business days to close the loan and then do an appraisal after, because we have an internal team to value. So we're not as reliant on the appraisal to know what the value is and to get comfortable. And so they'll do a feasibility study. A lot of times this can be post-close because we also have a construction team to make sure the project is feasible. So it's for loans with construction holdback. And so they'll do a study of your scope of work to determine how feasible that is, and also determine the after repair value.
Does it help during the application process if the applicant includes comps and those types of things, or do you do that kind of independently from what they send over?
That's a great question. Definitely, because everyone has a lot of work, right? Conventus credit team and the appraisal, third-party appraiser. So if you have comps that fit well with, the as is and the after repair, like they're going to look at that and they'll use that more than having to find newer comps on their own. Not newer comps, but just comps of their own on their own. So, and it just shows that you have done your own research, because that's what they're asking for. If the appraisals don't come in okay, is whether clients have comps. So it's great if you can support that already and have that ready, and it'll speed things up a lot. And yeah, I think sometimes there are aspects of the property that the investors know and the appraisers and lenders don't know, just because they haven't spent as much time digging into the project as the investors themselves. So so it's great to show them, like, this is what I see in the property, just to make sure they include that. So anything special that might make the property valued higher, like whether it's for the rent, for income properties, or the value for flips.
On the hard money loan, are you guys typically looking for some minimum investment amount by the flipper or developer in order to make the loan? So for example, if the property value is like 200,000 and you're providing a loan of like 175,000, are you looking for that developer to put in some additional minimum amount of money into the project?
So we like to see around 10% of costs at least put into the project by the developer as equity. But sometimes experienced people might raise that through a fund or something. So so we do allow that if they have enough experience. So but for most investors, we do like to see at least 10%, ideally 20%. And it might be higher for commercial properties.
Gotcha. So just to use round numbers, if the property is 200,000 and you're providing a loan of up to 180, you want to see the developer put in another 40K at a minimum.
So if
it's 20%.
So if the property is being purchased for 200, we want to see at least 20K put in the down payment by the investor. Usually they sometimes people get gifts and things like that, but we want to see 10% of the purchase price from the investor themselves at least. Usually 20%, so usually 40K.
Yep, got it.
But 20K is maybe okay if they have some explanation of where the other funds are coming from.
How would you define experience for rental properties only if there weren't previous flips?
That's a great question. So rental properties, we can use rentals too. And we don't require experience to do rental loans. Or for flips, we do like to see experience, but you could theoretically come in with no experience as long as you're putting enough equity in and you have a plan. And then for rentals, if you're putting 20% down and you're not doing any work to it, then you don't necessarily need to have experience either.
Got it. So the 10% wouldn't qualify for rentals. It's 20% kind of starting point.
Yeah, I would say so for most. So the 10% is mostly for experienced investors. And what I mean by that is 10 plus properties in the last 3 years. And so usually lenders want to see 20%. But you know, if you have some experience, maybe you can get 15%. And this changes all the time depending on the market also.
Gotcha. Okay.
That's
Thank
roughly-
you.
Yeah.
Correct me if I'm
Especially-
wrong, Brenda, but I think one thing to maybe highlight is what's nice about using a private lender like Conventus is you guys do have guidelines, but I think I keep hearing you say it kind of depends. It depends on experience because it's not like going to a traditional bank where they have to follow these rules before they issue financing. So that's why it is very dependent on experience and all of that. And then Masaki, just to clarify, so Conventus has many different loan products. So I think generally right now what Brenda's been talking about has been their fix and flip kind of like a hard money loan effectively for like maybe a dilapidated project that you're buying and then going to repair and then sell it or turn it into a long-term rental. And then there's a separate loan product for long-term rentals.
Mhm.
Gotcha.
And some people also use the bridge product for rentals if they're looking to stabilize and refinance after. Yeah, thanks for clarifying, Cliff. So a bit about construction loans. So how that works is we reimburse the client with draws. And so they send us a scope of work during the process with line items of what they're doing, how much everything's going to cost. And then sometimes they add contingency. And then during, you know, after the loan closes and when they're doing the construction, as they're doing the construction, they can get reimbursed for work that's been completed. And so what they'll do is they'll submit a draw request to our draws team and they will send out an inspector to take pictures to see what the changes have been done. And then we'll release the funds within 7 days, usually 7 calendar days of them requesting. And signing the loan documents. So yeah, it's pretty straightforward. We send the loan docs out and then we work with title and escrow to close.
And that title and escrow, that's local, that's I guess the buyer's choice who they work with, or do you all have preferred folks to make the process smoother?
Yeah, usually the client chooses, and they'll ask for referrals from us sometimes, and we can refer. Sometimes we might, you know, we might get asked to refer a company because there's something unique that's being done, whether it's, I think one thing that comes up is cross-collateralizing loans. So having multiple properties within one loan, not all title companies might have experience with that, and sometimes they might get confused. So we can refer people that have experience with that. And then structuring release provisions, which are, you know, if the clients decide to sell off parts of the property separately during the loan, the company might need to know how to do release provisions as well. But for most loans, people come in with their own escrow and title contacts. So a bit about loan amount. So we're around 80 to 85% of purchase price and construction, sometimes 90 for very experienced clients. For 5 units and up, typically 70 to 75, but we've gone up to 80 for experienced clients. And we've gone up to 85, maybe like once or twice since I've been at Conventus, so not very often. So mostly you would expect 70 to 75 for multifamily. And then, so mixed use would be a bit lower than that. So probably 60 to 70%, depending on how many residential units there are. So the more residential units there are, the closer it is to a multifamily, and so the closer an LTV it would be. So an example of a loan is if the purchase price is $1 million, the loan amount at 80% is 800,000, and then you can potentially get financing for 100% of the construction costs, depending on how much your scope of work is. So what we'll do is we'll take your purchase price and we'll take the work that you're doing to calculate the total costs. And then we'll try to figure out, how extensive is the work being done? Is it cosmetic? Is it structural? Or is it ground up? And based on that, we may lower the loan to cost that we want to be at. So for example, for ground up construction, we'll still do 80% of cost, but we might want your 20% to go into the project first. So that means, so if the purchase price is $1 million and you have $1 million budget, that's $2 million total cost. And so we want 400K to go into the purchase first, and we'll fund the 1.6 million to equal 80% of costs stay done. And so the rates right now, they're changing a lot. So right now they're around 9%, and origination fee 0 to 2 points, probably around 0 to 1 usually. 1,500 processing fee, 12-month term. Usually bridge loans don't have prepayment penalties, which is great, especially for flippers if they want to get in and out of projects super quickly. And so another example is for a loan amount of 800,000, 1% origination fee, you would pay 8,000 at close, and then you'll pay your title and escrow fees and the processing fee. And so the payments would be 6,000 per month, because you just take the annualized rate of 9% times 800,000 divided by 12 for the monthly payments.
Oh, one thing I just wanted to mention on that slide, Brenda, because I know for folks who might be shopping or like looking to purchase a home, you might be comparing this and go, wait, interest rates are on a 30-year fixed 6.5% or something. Why would someone come to Conventus and pay 9% plus? But just as a reminder, like a lot of these projects are not financeable. Like my first project in Philly, there wasn't flooring, the roof was kind of messed up, right? There's a hole in the wall. Those are ones that you can't go to a traditional bank, because when they send the appraiser, they're like, this is not fully livable. You can't get traditional financing. So your option really is to pay fully all cash, or come to a company like Conventus where you can finance it. And effectively, as Brenda mentioned, it's like a bridge option, right? You rehab it over the next 6 months, and then you can refinance it into one of Conventus's long-term financing options, or at that point, then go to Wells Fargo too, if you want to get traditional financing on the property.
Yeah, exactly.
Assuming you're going to keep it.
Yeah, definitely. And a lot of clients use us because of the speed. So if they're competing against multiple people for projects, like properties where the seller might be in a rush, they can put in a better offer if they say they can close, within 2 weeks or within 1 week. Or I know we financed a couple multifamily properties for that reason. The client was definitely qualified to get traditional financing for those properties, but he was able to put in a better offer and get the seller to sell to him because we were able to close sooner. So it was still worth it for him to do a bridge loan and then a more traditional loan, because then he can take his time with the traditional loan, because they might ask for a bunch of documents and they might not be able to close on time. But then he already has our loan at that point, so he's not in a rush to close to satisfy the seller.
Yeah, that's a good question. So when someone submits an offer, if they're planning to use Conventus financing, would they say it's an all cash offer?
So it's really up to the investor. Some people do that, but some people just say we're using her money loan, and sometimes the agents might not know what it is, and we'll just get on a call with them to tell them. It's kind of in between cash and getting traditional financing, and we'll tell them about our closing timeline and how it's more flexible and faster. So some people present it as cash if the seller doesn't know, or the agents don't know what it really is, but it's technically not cash though, so we don't really tell people to say it's cash, but it really depends on how people want to present their offers.
Can I chime in on that? Because I've done it before.
Yeah.
So I am an agent and I have used Conventus, and I have done an offer using, myself, representing myself. On the RPA, there is a box that you check other. I did ask my manager personally, I do residential. I did ask my manager, can I say cash? And they said, no, it's not cash. So you mark the box that says other, and then you explain to the listing agent that this is going to be treated as cash. We can close as cash, but technically speaking, it's not cash. I don't know if that's helpful, but that was my
That's
experience.
super helpful. Yeah. Yeah, that's exactly right. Because when people call us and say and ask us if it's cash, we have to tell them it's not cash. So it's probably better for investors to just tell them up front. But it's really up to them how they want to present their offers.
Brenda, is there generally flexibility on the 1-year term if it's a larger project that takes a little bit
Yes.
more involved?
Yes.
Okay.
Yeah, so we're able to customize our loans to fit what's being done. So we get that some projects might take 18 months, 2 years. So we'll be flexible there. And the longer the term, the higher the rate though. So you kind of have to, yeah, but it still might be cheaper than getting an extension on your loan.
Mhm.
So yeah, they can present you options like this is the option for 12 months, this is the option for 18 months, this is the option for 2 years. And sometimes they're able to keep the rate if you're willing to take on what's called a minimum interest period. So for example, for an 18-month loan, we might want 9 months of minimum interest. So that means that if you do pay the loan off at month 8, you just owe 1 month of interest. And so that way you're still able to get longer term for similar or the same note rate. Yeah. And so I definitely suggest talking to your lenders about extension options or longer duration terms, because we are seeing people having to refinance or get extensions on their projects, and that's definitely more costly than having that conversation when you originate the loan, because then you can know for sure you're going to get that term, versus when you're already close to maturity, it's dependent on whether the lender or the servicer approves that, and they might charge a hefty fee for that depending on their status and depending on the servicer. And sometimes sometimes the lenders might not know the servicer as in terms of like how much they're going to charge. So even though your lender is your advocate, they might not be able to control how much your extension fees are. So it's better to structure in the term ahead of time, because we all know some projects might get delayed and things like that. And it's better to think ahead in that aspect. So thanks for the question. So how to get the best rates? So of course, higher credit score, lower loan to value or lower loan to cost. So the more equity you put in, the more comfortable the lender would be. The more experience you have on title also, and then repeat business with one lending company. So referring other clients to the lender and developing a relationship there, doing multiple projects so that they can see your track record. It's really great for us to see completed projects too. And once we know, the type of projects that clients do and they're doing the same type of project, it's a lot easier for people to approve, because we see the track record and the quality of work that's been done. So loan terms, so usually around 150,000 to roughly 9 million. So 9 million would be, 5 million up would typically be for more than one unit, be for more multifamily projects, because we do finance luxury projects, but the loan to value would be a bit lower. So on the higher side, you would see more multifamily. The interest rates start at around 9%. They're probably 9 to 10.5 for most loans, and then they go up to 12.99 for things like land loans or second liens. And so origination fees around 0 to 1 point, but 2 points for things like land loans and second liens again. And so most terms are around 12 months for no prepay penalty for bridge loans. And then we used to go up to like 5 years with prepayment penalty, but now you see more like 3 years. So loan to cost around 90. loan to after repair value, which is LTARV is the abbreviation, is up to 70%. That's roughly where most lenders would be at. If you're a bit higher than that, they just need to have a conversation with you to get comfortable. So before you ask for a loan, and when you're looking at projects, you want to calculate the loan to ARV yourself just to see if it qualifies. And usually first position loans, 640 minimum, citizenship, green card or valid visa for the duration of the term, liquidity for the down payment, any construction costs that the lender is not financing, and then around 6 months of interest payments. So yeah, I kind of mentioned this before. We fund over 3 billion in 40 plus states. So these are the states that we're active in. We're mostly active in California, New York, New Jersey, Florida, Washington, and Hawaii, and Texas. And we're really looking to grow everywhere. And so I am based in California, and most of my loans are in California. So, but yeah, happy to connect if you want to learn about what people are doing in other states or what people are doing in your local area. And so a bit about Conventus. We're fast and responsive to clients. We customize lending product to fit people's needs, fast closing time. We can do loans where you cross collateralize. So as long as they're in the same state, we can do multiple properties in one loan to save on transaction costs. And it can do portfolio loans. So we don't like to charge hidden fees. So these are the types that I mentioned before. I didn't talk too much about long-term rental, which is also called debt to service DSCR loans. But those loans are basically around 30 years and the rates are around 6.75. So for those, we just want to make sure that the property, also again, the property itself has above usually around 0.8 DSCR, and we don't look at income, the personal income for that either. So we can send more info on this if you're interested.
Well, one note on this, yeah, I just wanted to highlight that that's really incredible because like for 30-year fix right now, it's in the high sixes, maybe even sevens in some cases. So Conventus is competitive with that, but also does not have as crazy of the underwriting process, right? So if you're transitioning to become a full-time real estate investor, you're not going to have W-2 to be able to go to I keep saying Wells Fargo. But in this case, you have an option to get fixed rate financing for 30 years and convert it into a long-term rental project. So that's really nice that you guys have this too.
Yes, thank you. So what we can help people with purchasing projects, refinancing projects, especially if they're at a pretty strict timeline to close. Brokers can also charge referrals fees. Depending on the state, there might be a license needed. I know California, you need a DRE license to charge a broker fee. But we love working with agents because they actually refer us a lot of deals and the quality of the deals are great. And faster closing timeline, easy application process, minimal documents needed, construction loans offered, and then ability to lend on properties that aren't stabilized yet to stabilize them. And yeah, again, cross-collateralizing properties. So yeah, that's it for me. Thank you so much for coming, and I would love to connect with you. So these are my emails. You can also text me or yeah, but thank you so much, Cliff, for having me again. And it's great to see what everyone's up to. And so yeah, thank you.
Yeah, thanks, Brenda. Any questions from folks? I didn't realize you're a 626. I grew up in the 626 too.
Oh, really?
To talk about
Nice.
that. Yeah. Maybe I'll start if folks are thinking about their questions. This one's kind of I guess it's going to be an odd question, but it was someone that couldn't attend who emailed me. It was kind of a twofold question. One is they were curious, where does Conventus get their capital to lend out? And then the second question was, is that an option for folks to give Conventus capital to lend out and to effectively private lend through Conventus?
Yeah, that's a great question. So we have different sources. So we have our own fund, and then we also have lines from institutions. So for our own fund, we would be able to have people invest. I would probably have to refer them to the capital markets team for that. But yeah, that'd be awesome.
Oh, cool. I told the person probably not. So I'm glad I asked. Any other questions? Maybe I had another one. Can you talk through I don't know, I think maybe it might be helpful for folks to understand the type of like properties that you've lent on before. So is there one that you can walk us through, like, oh, this is maybe like the typical scenario. Hey, it's a home in San Francisco that hasn't been kept up for 30+ years, or what's kind of like scenarios that you see where people take out private lending?
Yeah, so we do a lot of flips. So we'll lend on the purchase and the construction, and then they'll sell the property and kind of rinse and repeat. We kind of do that in a lot of different states. And then we also see people, especially in LA and San Francisco too, buy multifamily properties that aren't stabilized. And then they will either do tenant buyouts or relocation, and then renovate the units and then refinance into traditional loans or sell the properties once they have higher income from the properties. We see a lot of ADU projects right now, a lot of ground up projects too. So mostly ground up for single family too. And then we also do, what's unique about us is we do TIC projects too. So so sometimes, yeah, people do condo conversions as well. We do very interesting things that I didn't even know was possible before. Like we had a client that bought a motel basically and is converting to multifamily. So that's one of the more unique ones. But yeah, there's, we'll lend on things for the right LTV and the right price. So we're a lot more flexible than banks that, you have to fit their box or it won't work. But because we have different capital sources, we're able to fund depending on what the project is and everything.
Can I ask a question about that? So
Yeah.
actually, that's interesting information. I did not know that you did kind of mixed use, not mixed use, adaptive reuse projects like that. When you have an appraiser go out and determine value on that though, and it's like a hotel being converted into multifamily, what do there's not like there's tons of comps out there that say, yeah, this is totally worth that. So how do you figure that out?
Yeah, so they have to look at it as is, as a motel. So they can't, yeah, we actually have a lot of discussions about this internally, because sometimes investors see the opportunity and they add value to the properties for that opportunity. But for the lenders, usually we're on the more conservative side. So we just have to look at what it is right now and be able to lend on that. So we have to be okay with it being a motel, and for the day one loan amount to be kind of aligned with it being a motel instead of lending it as something that will become a multifamily. Well, that's why we'll do draws, because depending on different milestones, then we can release more funds because we can make sure that work has been done. But we just have to look at it right now as a motel, and then they can submit plans and let us know where they are in the permitting process for the after repair value or as completed value for it to be a multifamily. So yeah, sometimes that is kind of it's a bit different from what it is right now, what they're going to do. But as long as they submit evidence, this is what it's going to become, these are all the steps I need to do to make that happen, then our team and the appraisal will get comfortable with more of the value add portion, And so, so combined, we typically want to be at 70% of the completed value for the total loan amount. And so that's typically how we calculate for the loan proceeds.
Okay, gotcha. Thank you. That's really helpful.
No problem.
Hi, I had a question.
Yeah.
Hi, my name is Daniel Carrasco. I have a rental property in Brentwood, California. I'm in the process right now in constructing, to doing a garage conversion into an ADU. I recently got the permits approved, by the city of Brentwood. So, I could go with you through the financing process for the remaining project of the ADU. And then, what type of loan do you think I should apply with you if I want to move forward?
That's a great question. So you own the property right now, right? And is there debt on the property?
Yes, there is. I own the property. I right now I have tenants in the front property, but it was already a garage there. I converted it. I was able to get the plans approved. So now I'm just waiting to break ground.
Okay, so your plan is to convert the garage and get financing for that portion?
Yes.
Okay, so yeah, what we can do in that case is we would probably have to do a refinance of your existing loan and then add a construction loan on top. So that's because we typically have to be in first position in order to reach that higher loan to cost or loan to value. So we'll probably have to do like a rate term refinance depending on how much the current balance is on the property, and then we can add a construction loan on top for
Got
you
it.
for you to fix up the ADU or turn the garage into an ADU.
Okay. Yeah, that was my kind of main thing because I got it at 4%. I know if I do a refi, if I move forward with you guys, it'll be you said 9%.
Yeah, so I understand some people might not want to do that if you already have a low rate on the first position. So if you have other properties, you could cash out of those properties just for the renovation part. And that way you don't have to pay origination points on the refinance plus the construction proceeds. So that way you're only paying you're only paying the transaction cost for the amount that you need, which is basically what you're using to fix up the garage.
Okay. And then when I do decide to go with you guys, I just submit the actual ARV breakdown and then you'll see if it makes sense to move forward.
Yeah. Typically we have a list of questions I can send you, and it's pretty straightforward. So what, address, how much it's worth right now, what the current debt is, what you're looking to do, the budget, and what the property will be valued at after, and then also square footage and property size and things like that for as is, and then ARV.
Okay, awesome. Thank you.
Yeah, no problem.
Congrats, Daniel. That's awesome that you're building an ADU.
Yeah,
Sounds like
congrats.
a good idea and great project.
Thank you, guys.
Any other questions? I'll try to sneak in a quick one then. Brenda, for the unstabilized multifamily, you guys are looking then at the expected kind of cash flow and all that from the stabilized property to lend effectively the ARV.
That's a great question. So that's why we finance so many multifamily properties. It's because a lot of the ones that investors are buying are not stabilized and don't qualify for bank financing. So sometimes the cap rates are even negative if it's vacant or something and they have expenses. So as long as we know that there's a plan to get tenants in or to stabilize, then we look at the stabilized cap rates and stabilized income. And then that's how we qualify the property. And and then we'll do an appraisal on the as-is value, and typically we want that to be aligned with the purchase price, and then we'll do around 75 to 80% of that for as-is, and then we'll we'll get them a construction loan so that they can fix it up and stabilize.
All right. Any other last questions? Anyone want to type in a question, or if not, thanks so much for joining on your lunch breaks on a Wednesday. And hopefully you found the session useful, and this is so great to have you, Brenda. And I'll send out the recording too to everyone so that you can review it again if needed.
Great. Thanks, Cliff. Thanks, Brenda.
Cool. Thanks so
Thanks,
much for
Cliff.
joining, Brenda.
Everyone.
See y'all. See you, Justin. I'll see you later today. Bye.
Bye.